All right. So let's begin. In this session today, we're going to be solving the descriptive part of the RTP applicable for CA Inter Income Tax May 2023. All right. There is already a video uploaded regarding the MCQ part. All right. In this part, we're going to focus on question number 9 onwards. All right. Let's begin. Let's start off. Some of the questions are plain simple, all right, but some of the questions, especially this one question here on depreciation, there are some amazing questions in this RTP, all right. So that is why I thought let me have a live online session as well, in addition to uploading it on our YouTube channel, so that in case you have any doubts, then and there we can clarify them. All right. So let's start off with question number 9 now. Let's read the question. What exactly is the question asking us? Mrs. Roma, an Indian citizen, is a government employee working for the Indian government. She submits the following information for the previous year ended 31st March 2023. Determine the gross total income of Roma, ignoring the provisions of 115 BAC, on the assumption that she is resident but not ordinarily resident, RNOR, or she is non-resident, NR. Okay, so the question tells us that we have to find out her GTI. Okay, but who is she? She's an Indian citizen. She's a government employee working for the Indian government. So let me give you a small revision of the concept involved first. Two concepts I want to discuss with you. Thing number one, whenever I talk about salary, where does this salary accrue? The salary accrues wherever I render my services. Okay, if I render my services in India, the salary will accrue in India. If I render my services outside India, the salary will accrue outside India. So salary accrues wherever I render my services, basic rule. Okay, but to this rule, we have an exception. What is the exception? The exception goes like this. Listen to me very carefully. In case my assessee is an Indian citizen, okay, and this Indian citizen is employed by the government of India. Now, even if this Indian citizen is going to render services outside India, okay, still, even if all these conditions are fulfilled, even if the services are being rendered outside India, still, if all these conditions are fulfilled, the salary will accrue or arise where? The salary will accrue or arise in India. Are you understanding? Yes, the general rule is that the salary will accrue wherever I render my services. But we have an exception. If my assessee is an Indian citizen employed by the government of India, rendering services outside India, if all these conditions are fulfilled, then the salary income is going to accrue in India. Generally, the services where the service is rendered, that determines where the salary is accruing. So services are rendered outside India. So ideally, where is salary supposed to accrue? Outside India, right? But this is an exception. Even though the services are being rendered outside India, if I'm an Indian citizen and if I'm working for the government of India, even though the services are rendered outside India, the salary will accrue in India. Crystal clear with my first concept, everybody? Yes, keep the participation in the chat box proper. Keep it very participative, guys. Till here you've understood, right? This was the first concept. Second concept, they're asking us about RNOR and they're asking us about NR. See, if I am an RNOR, what kind of incomes will be taxed for me? 3 incomes will be taxed for me. All those incomes which accrue in India will be taxed for me. All those incomes which are received in India will be taxed for me. In addition to this, if I have PGBP, it may be from a business or it may be from a profession. If it is from a business and if this business is controlled in India, or if it is from a profession and this profession is set up in India. If any of these incomes I have, these incomes will be taxed for RNOR. Incomes which accrue in India, incomes which are received in India, incomes from PGBP where the business is controlled in India or the profession is set up in India. Guys, these are keywords. You can't change these words, okay? You cannot interchange. You cannot say business set up and profession controlled. It is business controlled in India and profession set up in India. understanding. And what is my assessee is non-resident, guys. What kind of incomes will you tax for the non-resident? You will tax only those incomes which accrue in India and only those incomes which are received in India. Question for you: what do you call these incomes? Incomes which accrue in India, incomes which are received in India, what do you call these incomes? They are called Indian incomes. You know that. Right, guys? So totally three concepts involved over here. Concept number one: generally salary accrues wherever I render my services. If I'm rendering my services outside India, the salary also will accrue outside India. This is a general rule. But we have an exceptional case. In case I am an Indian citizen employed by the government of India, even if I'm rendering services outside India, still the salary will accrue in India. Okay, and then we learned RNOR, what kind of incomes are taxable, and NR, what kind of incomes are taxable. Now let us begin solving. So we'll have a 3-columnar table. We'll have one broad column for particulars. Okay, we'll have one column for RNOR, and we'll have one column for NR. Now, they're asking us to find the gross total income of the assessee. See, first of all, we will have to inform the examiner that for RNOR, what kind of incomes are taxable, for NR, what kind of incomes are taxable. So, what you can do is, you can simply make a note here itself, or you can also give a separate working note for that. All right. So let us say I make a note of that over here itself. Under RNOR, please write down along with me Indian incomes, in brackets, incomes that accrue in India or are received in India, close brackets, and incomes from businesses controlled in India and professions set up in India are taxable. By the way, we're going to be working out the questions with proper presentation, okay? So that you know how exactly they have to be presented in the examination. So write along with me so that you get used to it. All right, the presentation will take care. So see, you know that you're not going to have the time to take a pencil and a scale and underline and all. So do whatever underlining you want to do now itself. What do you think you will underline over here? Number one, Indian incomes. Then number two, businesses controlled in India. And number three, profession set up in India. All right, once you've done this, now there's no scope for the examiner to deduct any marks relating to this. Now come to NR. For NR, what will we write? Indian incomes. Indian incomes. In brackets, write down incomes that accrue in India or are received in India. All right, so this is it about our basic theory that what incomes will be taxed. Now let us look at the questions one by one and we'll handle it. So the first point, salary income received in Malaysia for services rendered there. Now, all my conditions are fulfilled. My assessee is an Indian citizen. He is working for the government of India. He is rendering services outside India. Even though he's rendering services outside India, tell me, where will this income accrue? Where will the salary income accrue? The salary income will accrue in India, right, guys? Why? Because all three conditions, exception applicable, right? So therefore, write down under particulars, point number one. Point number one, write down salary. Salary income. In brackets, give reference to working note number one. Okay. Leave around 10 lines gap. And then start a new working note number one. Give the heading salary income. Okay. Under this, write down as assessee, is an Indian citizen, next line, working for Government of India, rendering services outside India, the salary income will be deemed to accrue in India. Assessee is an Indian citizen working for Government of India, rendering services outside India. The salary income will be deemed to accrue or arise in India. Guys, by the way, I'm getting reminded of another concept now. The salary income deemed to accrue in India, taxable, fine. But what if the question had told us about foreign allowances? What if the question had told us about foreign perquisites? What would you do? See, listen carefully, guys. Salary, foreign allowances, foreign perquisites, all the three will accrue where? All the three will accrue in India only. If all these conditions are fulfilled, salary, foreign allowances, foreign perquisites, all the three will accrue in India. But salary alone will be taxable. Foreign allowances and perquisites will be exempt. Are you understanding? Are you able to recall this concept? Yes. If all these conditions are fulfilled, then no doubt all the three will accrue in India. Even though services are being rendered outside India, it will still accrue in India. But salary will be taxable and foreign allowances and foreign perquisites will be exempt. Okay. So this was just for your knowledge. What I'll do is I'll put this over here so that if you're revising later, you can take help of this. Coming back to the first working note. Therefore, it is an Indian income, taxable for all assessees. Please notice the steps. I first concluded it is accruing in India. On that basis, I concluded it is an Indian income. On that basis, I concluded it is taxable for all assessees. There is a question in the chat box. Is a recorded class on the first RTP session available? It is there on my YouTube channel. The first part of the RTP you can take over. You can watch over there. All right. So coming back to my main answer now, we have concluded it is taxable for all my assessees, whether RNO or whether NR, because source is in India. So what is the amount? 2 lakhs. Does something come to your mind? But I can't write straight away 2 lakhs in the column. The question says salary income. The question does not say compute it. So which means I have to avail the standard deduction. So salary income, under this write down gross salary. Under both the columns write down 2 lakhs. Then under that, less deductions under section 16. Which deduction are we subtracting? Standard deduction. $50,000 under both the columns. Okay, so what will our net number be? 1,50,000 here and 1,50,000 here. That's it with our first adjustment. Then second adjustment, profit from business carried on in Orissa. What about this? The business is carried on in Orissa. The business is carried on in India. So the source of the income is in India. Hence, it's going to be taxable for all assessees. So number 2, PGBP. Give the heading PGBP. Under PGBP, write down Orissa. In brackets, write down Indian income, taxable for all. So what is the amount? 80,000. 80,000 will be taxed for both my assessees. Then number 2, we have loss from the business carried on in Baroda. Again, this is from India. The source is in India. Hence, I can consider this for all my assessees. But then this is a loss. All losses generally we consider later. So I'll keep a note over here, maybe Over here, I'll keep a small note that I'm supposed to consider business loss of 20,000. Later, for both, I'm supposed to consider. Losses we always handle at the end. Then, profit from business carried on in Paris. Income is earned and received in Sydney. Business is controlled from Paris. Is it Indian income? Is it accruing in India? No, it is earned in Sydney, outside India. Is it received in India? No, it is received in Sydney, outside India. Is it from a business which is controlled in India or from a profession which is set up in India? No, it is from a business which is controlled from Paris. So, conclusion, it's neither going to be taxed for RNOR and nor will it be taxed for NR. But then we cannot ignore it from here. We'll still have to make a note. So, under this, write down Paris business. Too much to write may not fit over here, so give reference to working note number 2. Okay, after your first working note, open the second working note, give the heading Paris business. Under this, write down as the income accrues and is received outside India. Come on. It is not an Indian income. It is not an Indian income. Hence, it will not be taxable for non-resident. Next line. Also, the business is not controlled in India. Hence, it will not be taxable for RNOR also. It will not be taxable for RNOR also. So come back to your main answer under both, not taxable. Give these notes, guys. Give it all to the examiner in your answer paper. Do not leave any scope for him to deduct marks. You'll have to tell him that why are you saying it's 0. All right. So we first wrote that it is not an Indian income, and therefore for non-resident it will definitely not be taxed. And also it is not from a business controlled in India. Hence, even for RNOR it will not be taxed. Until you're clear. Even this we have handled. Then we have one more loss, guys. Loss from business carried on in Canada. Profits are not received in India. Business is controlled from Dehradun. Tell me, is the source in India? No, the source is in Canada. Is it received in India? No, it is not received in India. But it's from a business which is controlled in India. The business is controlled in India. Hence, for whom will it be taxed? It will be taxed for RNOR, not for NR, but for RNOR it will be taxed. But then it's a loss, guys. And what do we do with losses? We handle losses later. So I'll make another note over here. We have another business loss of 46,000, but this is only for RNOR and not for NR. We have to handle this later. Then we have unabsorbed depreciation of business in Canada. The same business unabsorbed depreciation we have. Obviously, even this we will consider only for RNOR, same reason. So unabsorbed depreciation 16,000 also we will handle later. Then we have profits from Indonesia business controlled from Delhi, and 60% of the profit is deposited in a bank in Indonesia and 40% is received in India. Tell me. Tell me about non-resident first. Is it sourced in India? Is the income accruing in India? No, it is Indonesia business. Is it received in India? Yes, 40% is received in India. So for NR, 40% will be taxed, guys. But when I talk about RNOR, the business is controlled in India. So for RNOR, it's going to be fully taxed. You'll understand as I give you the note. Write down over here the next point, Indonesia business. Okay, and give reference to working note number 3. All right, after your second working note, open the third working note number 3. Give the heading Indonesia business. All right, and under this, write down, give the subheading non-resident and write down the income accrues outside India. But 40% of the income rupees, what is 40% of 70,000? 28,000. Rupees 28,000 is received in India, and becomes an Indian income. Hence, taxable for the non-resident. Then give the subheading RNOR. RNOR, what did we discuss? No doubt the income is accruing outside India. No doubt only 40% is received in India, but it is from a business which is controlled in India, guys. Hence, fully taxable for RNOR. So under RNOR, write down as the business is controlled from India. It will be taxable. For RNOR. So come back to your main answer. For NR, only 28,000 you're going to tax. For RNOR, full 70,000 you're going to tax. Are you all following till here? Crystal clear? Yes, for RNOR I'm taxing fully because business is controlled in India. Even this we are done. Now we are left only with rent. Rent will go to IFHP. IFHP will handle at the end. Let us finish off the losses now. All right, we are doing PGBP. All right, so PGBP will finish off the losses. All right, so here we have totally 3 losses. We have business loss, another business loss, and unabsorbed depreciation. Out of the 3, obviously, which of the 3 will I give priority? I will give business losses priority, right? So from this, less business loss. If you remember, we had 2 business losses. One of them was this one, loss from business in Baroda. This we said will be for both. And we had one more loss from Canada. This we said was only for the RNOR. Okay, so business loss Baroda. How much was a Baroda business loss? We've even made a note over here, 20,000. This I will adjust for both. 20,000 and 20,000. Then we also have another business loss from Canada. This I'm going to consider only for the RNOR, right? How much is it? 46,000. Why are we considering for RNOR? Because it is from a business controlled in India. So in brackets, write down over here, as business is controlled in India, considered for RNOR. All right, 46,000 here and 0 here. And even after this, how much are we still left with? Just PGBP, how much are we left with? Minus 20,000, minus 46,000. We are still left with 84,000 here. And here we're left with 80,000, 80,000 plus 28,000 minus 20,000. Here we are left with 88,000. Okay. Then what else can we subtract? Unabsorbed depreciation. Yes, unabsorbed depreciation only for the Canada business we had 16,000. So put over here Canada. And adjust 16,000 only against RNOR. You know why we are adjusting only against RNOR, right? Because NR will not be attracted over here because neither is the income accruing in India nor is the income received in India. All right, it is accruing in Canada, received in Canada, but for RNOR I'm considering because business is controlled in India. So what is going to be the net PGBP of my RNOR? 84,000 minus 16,000. 68,000 is going to be the PGBP of RNOR. And on the other hand, what is NR's PGBP? 88,000. Until here, do you have any questions? Till here, is it understood? Yes, guys. Fine. Then after this, what else? Coming to the third part, we have one more head involved over here. We have rent from house property situated in Canada and received in Canada. Will I consider this? No, because the source is in India and it is also the source is outside India and it's also received outside India. So it is clearly what kind of an income? A foreign income. It is neither going to be taxed for RNOR nor will it be taxed for NR, but I can't ignore it. I'll have to write down. So open the third head, IFHP. All right. Under IFHP, write down. Here itself, we can write down no need of a separate working note. Write down as the rent accrues outside India and is also received outside India. Come on. It is a foreign income, not taxable for RNOR and NR. So even over here 0, even over here 0. It is neither received in India nor is it sourced in India, nor is it accruing in India. So come on, add up. What is the gross total income of our SSE? We first of all had salary income 1,50,000, the salary income, and we have PGBP 68,000. Here we have salary income 1,50,000, PGBP 88,000. So total for our NOR, it's going to work out to 2,18,000, and for NR, it's going to be 2,38,000. Do you get these numbers? Simple question. Yes. What was the biggest learning through this question? I would say our biggest learning through this question was about the exception. Generally, salary accrues wherever you render your services. But if you are an Indian citizen and if you're working for the government of India, even though your services are rendered outside India, it's going to be deemed to accrue or arise in India. All right. So with this question, I think you also sort of got an idea about the presentation. All right. Generally, what happens is these kind of questions, students get stuck with the presentation, but you've sort of understood that this is how you can handle a question which is based upon residential status and scope of total income. All right. So with this, I think we come to an end to this question. Let us go to the second question now, question number 10. Question number 10 is a nice, interesting question. It's a combination of IFHP and PGBP. All right. Let's read the question first. Mr. Akash owns a residential house property whose municipal value, fair rent and standard rent are 1,60,000, 1,70,000 and 1,90,000 respectively. The house has two independent units. Unit 1, okay. Unit 1, which is 25% of floor area, is utilized for the purpose of his profession. So Unit 1 is self-occupied for his profession, and Unit 2, which is 75% of the floor area, is let out for residential purposes at a monthly rent of 8,500. Municipal taxes, 8% of the municipal value, were paid during the year by Mr. Akash. He made the following payments in respect of the house property during 22-23. We have light and water charges, we have repairs, interest on loan taken for the repair of the property. Mr. Akash has taken a loan of 5 lakhs in July 2016 for the construction of the above property. So guys, there are two loans. First of all, we have loan taken for the repair of property, and then we have one more loan of 5 lakhs for construction of the property. So we have two loans. Construction was completed on 30th June 2019. He paid interest on the loan at 12% per annum, and every month such interest was paid. No repayment of loan has been made so far. So entire loan is outstanding. Okay. Income of Mr. Akash from his profession amounted to 8 lakh during the year without debiting house rent and other incidental expenditure, including admissible depreciation of 8,000 on the portion of the house used for profession. What are they asking us? Determine GTI of Mr. Akash, ignoring the provisions of section 115 BAC. Let's begin. Let us work this out. Let us read. We've already read the question and we've identified that we have two units. One unit is self-occupied for professional purpose. Another unit is let out. At this stage, I want you guys to be aware of something. See, your house property may either be let out or it may be self-occupied, guys. If it is let out, it may be let out for residential purposes or it may be let out for commercial purposes. Similarly, if you're self-occupying it, if you're yourself using it, you may be using it for residential purposes or you may be using it for commercial purposes. Now, if it is let out for residential purposes, then your entire income goes to the head IFHP. Similarly, if it is let out for commercial purposes, here also your income goes to the head IFHP. But if it is self-occupied for residential purposes, you will put it under IFHP. But self-occupied for commercial purposes, what do you do, guys? If you're going to use your own property for your business or profession, if you're going to self-occupied for business or profession, where will you put it under? You will put it under PGBP. So this is something that you should be aware of. If you're going to self-occupy it for business or profession, you will put it under PGBP. Otherwise, let out income, whether used for residential purposes, whether used for commercial purposes, will go under the head IFHP. Keeping this in mind, this let out portion will go to IFHP, but this portion, which I'm self-occupying for my professional purposes, this will go to the head PGBP. So they're asking us for GTI. Two different heads are involved. Let us begin. We'll start off with the IFHP head. All right, so write down, give the subheading over here, part A, IFHP, in brackets write down, unit 2, 75%. So we're doing the calculation only for unit 2. Guys, this unit is a let out unit. Now, can you tell me, how do you start the calculation for a let out unit? You start with gross annual value. So gross annual value, for this you need municipal value, fair rent, standard rent and all those numbers are given to us. So under gross annual value, what's our first step? Step number 1 will be municipal value or fair rent, whichever is higher. Now municipal value is 1,60,000. Can I take that 1,60,000 as it is, guys? No, this is for the entire property. I am doing the calculation only for 75% of the property. So I'm supposed to consider only 75% of these numbers. So municipal value is 1,60,000. 1,60,000 into 70%, 75% I will consider, which is going to be how much? 1,60,000 into 75%. This will be 1,20,000. And what about fair rent? Fair rent is 1,70,000. So 1,70,000 into 75%. Again, I hope you understood why I'm calculating 75%, guys. Right? Because I'm doing the calculation only for the 75%. This only for this part of the property. So out of these two numbers, I'm supposed to pick whichever is higher. Which is higher? 1,27,500. Then comes step 2. Step 2 will be whatever our step 1 number is, that is 1,27,500. I will compare this with standard rent, right? And what is a standard rent in our question? 1,90,000. Again, same thing. 1,90,000 is for the entire property, but I'm going to consider only 75% of this, which is going to be 1,42,500. Now, out of these two numbers, I'm supposed to pick whichever is lower, and which is lower, 1,27,500. This step 2 number, by the way, what is this also called? This is also called reasonable expected rent. Right? Then after this, we have step 3. What will step 3 be? Step 3 will be actual rent minus unrealized rent. Now, what is the actual rent? For how much has my assessee let out the property? Unit 2, he has let out at a monthly rent of 8,500. So 8,500 into 12, which works out to 1,02,000. Okay, the question doesn't talk about any unrealized rent and all. So actual rent minus unrealized rent, I'll stick to 1,02,000. Then comes step 4. Step 4 is always step 2 or step 3, whichever is higher. So what is my step 2 number? Step 2 number is 1,27,500. Step 3 number is 1,02,000. Out of these numbers, I'm supposed to pick the higher number, which is clearly 1,27,500. Okay, then after this, I consider any vacancy loss. Do we have any vacancy loss in this question? No. Everybody has their own method of computing GAV. These are the steps which I generally follow. When I come to vacancy loss, I tell students that if step 2 was higher, then you do not consider vacancy loss. If step 3 was higher, then you subtract vacancy loss. What we do is actual rent we consider for all 12 months. Even if it was vacant, we consider for all 12 months. Okay, because vacancy loss will anyways be covered in step 5. Step 5, vacancy loss, when will you touch upon it? You will touch upon vacancy loss only if step 3 is higher. If step 2 is higher, you don't touch vacancy loss. Here, number 1, step 2 is higher. So I don't touch vacancy loss. Even otherwise, there is no vacancy loss here anyways. So vacancy loss is 0. So step 6, guys, what is my GAV going to be? Our GAV will be step 4 minus step 5, which is going to be 1,27,500. So we have a gross annual value number. Let us proceed forward. After this, what do we do? Our calculations, how do we proceed? Gross annual value, we have already concluded this is 1,27,500. From this, we subtract municipal taxes paid. This word paid has huge significance. I consider municipal taxes only if I have actually paid them. Municipal taxes are 8% of the municipal value. I want only the municipal value of the 75% of the property, which is 1,20,000. So this 1,20,000 into 8%, how much municipal taxes have we paid? We have paid 9,600. So net number 1,17,900. This becomes our net annual value. Right, guys? From this, what do we subtract? We subtract deductions under section 24. How many deductions will we have? 2. Number 1, we will have standard deduction, and standard deduction is how much? Show the calculation. 1,17,900 into 30%. 30% of this number, which is going to be 35,370. Then one more deduction. What is the second deduction? Interest on borrowed capital. Okay. Now here, those of you over here who are the workout batch students, can you tell me, is anything coming to your mind? Is any rule coming to your mind? Any rule that you're thinking of? Interest on borrowed capital? Very good, guys. Very good. You're supposed to think about pre-construction interest. Listen, everybody listen. As soon as you come to interest on borrowed capital, you are supposed to think about pre-construction interest. Take it as a rule. A lot of times what happens is students know very well what is pre-construction interest and how to calculate. But in the examination, they forget that they even have a concept called pre-construction interest. The reason being, look at the question. The question will never clearly tell you also calculate pre-construction interest. The question will never so clearly tell you that. So you've got to make it a rule for yourself that whenever you come to this step, always pause and check, do you have pre-construction interest? Now, do we have pre-construction interest in this question? How do we know that? See, when was the construction completed? Construction was completed on 30th June 2019. Okay. And when did we borrow the loan? We borrowed the loan in July 2016. So even before the construction was completed, pre-construction loan is existing, which means we have pre-construction interest. Obvious, right? Even before the construction is completed, the loan is existing. So we have pre-construction interest. A proper working note we'll have to give. In brackets, write down working note number 1. Leave some gap, maybe some 3 to 4 lines gap, and open your first working note. Give the heading interest on borrowed capital. Interest on borrowed capital. Okay, now under this, first of all, let us handle pre-construction interest. Now, pre-construction interest is one complicated concept, the only concept which students find difficult in the entire IFHP chapter. Everything else is fine. So, for pre-construction interest, I'll give you a set of steps to follow. Blindly follow the steps in the examination. You will make sure you get the perfect answer. All right. The steps are like this. The very first step will be, what was the date of completion of construction? See, these steps will take care of your presentation also. They will take care of your speed also. They will take care of your accuracy also. Okay. Otherwise, there's too much to think in pre-construction interest, which in the examination environment may result in silly mistakes. So follow the steps religiously. You will, I assure you 100% your answer will be perfect and the fastest. So date of completion of construction. When did we complete the construction, guys? Construction was completed on 30th June 2019. This is your first step. Okay. Your second step will be preceding 31st March. Just before 30th June 2019, what was the last 31st March, guys? It's going to be 31st March 2019. Compare this with the date of repayment. Do we have date of repayment of loan? Does the question talk about repayment? No. In fact, question says no repayment has been made. So do we have a date of repayment? No. Otherwise, generally what we do is we take the preceding 31st March, compare it with the date of repayment. Out of these two dates, you pick whichever is the earlier date. So which is earlier? Whichever is earlier. Earlier over here would be 31st March 2019 only. Okay, so date of first step, date of completion of construction. Second step, preceding 31st March or date of repayment of loan, whichever is earlier. Then comes step 3. Step 3 will be the pre-construction period. The pre-construction period will always start on the date on which you borrowed the loan. When did you borrow the loan? The loan was borrowed in July 2016 and it will always end on the step 2 date. What is the step 2 date? 31st March 2019. First step, date of completion of construction. Second step, preceding 31st March or date of repayment of loan, whichever is earlier. Third step, pre-construction period, which starts on the date on which you borrowed the loan and it will end on whenever the step 2 date is. Now, how long is this period? If you see 17, 18, 18, 19, we have 2 full years. So apart from these 2 full years, we have from July 16 to March 17. We have those 9 months also. So it's going to be 2 years and 9 months. I can simply call it as 33 months, guys. This period. Then comes step 4. Step 4 will be the most important step here, the pre-construction interest. That is, in this period, how much interest have we paid? The loan was 5 lakh rupees. The loan carried 12% interest. So 5 lakh rupees loan into 12% interest for how long? We're calculating for 33 months. So 33 by 12. How much will this work out to? 5 lakhs into 12% into 33 by 12, this will work out to 1,65,000. Now, this pre-construction interest you're going to get as a deduction across 5 years. So, step 5 will be nothing but your pre-construction interest divided by 5. That is 1,65,000 divided by 5. So, every year, how much are you going to get? Every year, 33,000 deduction you're going to get. Okay, but do not stop over here. Also, please check this 33,000 you're going to get as a deduction for which year? You're going to get it as a deduction for 5 years. 5 years starting when? 5 years starting from the year in which you completed the construction. When did you complete the construction? Which year is this? This is previous year, 1920. This year plus 4 more years. So 1920, 2021, 21, 22. Then we have 22, 23 and finally 23, 24. Now we are doing the calculation for which year? Assessment year 23, 24, which means previous year 22, 23. Is 22, 23 there in this list? Yes. So in our current year pre-construction interest, my assessee can enjoy. And how much? 33,000. But listen, this 33,000 is for the entire property. We are calculating only for the let out portion. So for the let out portion, what will the pre-construction interest be? Make a note of that also. Pre-construction interest allowed for unit 2 is equal to 33,000 into 75%, which will be how much? Which will be 24,750. Is still clear, guys? Are you comfortable with pre-construction interest? Yes, you start with the date of completion of construction. Then you see the preceding 31st March or date of repayment, whichever is earlier. Then what was the pre-construction period, which will start on whenever you borrowed the loan and it will end on the step 2 date. Then step 4 will be pre-construction interest. That is, in this period, how much interest are you paying? Then this divided by 5 will give you your pre-construction interest per year. You can claim this for 5 years, starting from the year in which you completed the construction. You completed the construction in 1920, so 1920 plus 4 more years, totally 5 years. All right, so we're done with pre-construction interest. Now let us come to point B under the same working note. What about current year interest? See, they say that this 5 lakhs loan is still outstanding, guys. So current year on this 5 lakhs loan, I would have paid 12% interest, which is going to be 60,000. And also, we had taken one more loan for repair, remember? Yes, for a repair, interest on loan taken for repair was 36,000. So this 5 lakhs is regarding the construction loan that we took, the loan for construction of the property. We took one more loan for repair of property. Tell me, for let out property, will I consider repair loan also? Yes, I will consider all loans relating to the house property. And these loans, it's not necessary that you have to borrow these loans from the bank or financial institution. In IFHP, you can borrow the loans even from friends and relatives. You will consider them as well. And under IFHP, these interest amounts, it's allowed as a deduction on accrual basis, which means whether you've actually paid the interest or not, irrelevant. Payment is important only for municipal taxes. But talking about interest, whether you have paid the interest or not, accrual basis itself, you can take a deduction. So repair loan, how much interest you have paid? 36,000. But guys, these are for the entire property. But we are calculating only for 75% of the property. So 75%, how much will the interest be? For the construction loan, it's going to be 45,000. And for the repair loan, it's going to be 27,000. So what is the total current year interest, guys? 72,000. Now, if I'm going to ask you the total interest allowed under section 24, that's going to be how much? Total interest deduction under section 24. How will you calculate this? Total. What's the pre-construction interest part? Pre-construction interest, we've already concluded. This is going to be 24,750. And how much is the current year interest? We have already concluded. Current year interest is 72,000. So total 24,750 plus 72,000, 96,750. This will be the total interest allowed. Now listen, let out property. Any limit on the interest? No limit, because it is let out property. So this full 96,750 I will allow as a deduction for interest. Now in my working note, there is everything. All my step marks I will get. I've not left any scope for the examiner to deduct marks. Pre-construction interest, I've given all the steps. I calculated for the 75% of the property. Current year interest also I calculated for the 75% of the property. And then I also give the sum total. I have not left any scope for the examiner to deduct any marks. This is also done. So what is the net number now? 1,17,900 minus 35,370 minus 96,750. You get a negative number, 14,220. So do not write income over here. What will you write? You write loss. Loss from house property. So our loss from house property from this unit 2, from the 75% of the property from unit 2, we have a loss of 14,220. Are we crystal clear with the IFHP discussion, everybody? Perfect understanding? Yes. Now, can we proceed forward to the next set of discussion? Yes, this was only for unit 1. So for unit 1, what have we done? This is the first part of our answer. IFHP we have calculated, and we've also given the working note. Now write down the heading part B. Part B, PGBP, in brackets write down unit 1, 25% of the property. The portion which is self-occupied for business or profession will be assessed under PGBP. What you will do over here is, you will see what is your business income. From the business income, you will subtract all expenses relating to this unit. Story over. Simple as that. So what is my business income? My assessee's business income in the question, income from his profession amounted to 80,000. So not business income. He has professional income. How much is it? 8 lakhs. From this 8 lakhs, I'll simply subtract all expenses relating to this house property. I'll get my PGBP number. Now, what are the expenses? Number 1, he has municipal taxes, guys. Municipal taxes is 8% of the municipal value. So less municipal taxes. Now, please do not forget, you're calculating only for 25% of the property. The municipal value is 1,60,000. So 1,60,000 into 8%, this is total municipal tax. But we are calculating only for 25% of the property, which is going to be 3,200. Okay, you're getting a hang of it. Then what are the other expenses? We have light and water charges, 2,000. So less light and water charges. Total is 2,000, but you are calculating only for 25% of the property. So that's going to be 500. Then repairs 1,45,000. So less repairs. Again, same thing. 1,45,000 is for the entire property, but you are calculating only for 25% of the property, which is going to be 36,250. Okay, then we have interest on loan for the repair of the property. Interest on loan taken for repair. Total interest we have 36,000, but out of 36,000 we will consider only 25%, only to the extent to which it relates to the only to the extent to which it relates to unit 1. That's going to be 9,000. Then we have another loan of 5 lakhs taken for the construction of the property, and if you remember, that loan was not repaid until now. So interest on loan taken for construction, 5 lakhs is the amount of the loan. It carries 12% interest, and I'm going to consider only 25% of that interest, and that's going to be 15,000. Got it till here? Any other expense, guys? Then they've also given us depreciation. Depreciation 8,000 on the portion of the house used for profession. So they've given us depreciation only to the extent of this unit, and that is 8,000. So find the net number. What is the PGBP of our assessee? You will get 7,28,050. Is our answer right? Do you get this number? Yes, this is going to become the PGBP of our assessee. Now, what is the question asking us? The question is asking us the gross total income. And we have only two heads over here, IFHP and PGBP. From IFHP, I have a loss. From PGBP, I have income. Can I net them off? Can I set off my loss from house property against PGBP? Yes. Inter-head adjustment of loss from house property allowed, against any head allowed, but maximum only 2 lakhs allowed. And here it is anyways not more than 2 lakhs. So give the last heading, part C, gross total income. Gross total income. Under this, we have a PGBP of 7,28,050 less loss from house property. What is our loss from house property? 14,220. So net number 7,13,830. This is going to be the gross total income of our assessee. A good question, guys. A lot of concepts got revised under IFHP. I would say the star part of this, the main part of this entire answer was a pre-construction interest discussion. Right? Are you all getting comfortable? Till here, are we comfortable? Yes, we worked out 2 questions, and both the questions we have worked out with proper presentation. So I hope you're getting a hang of how you can present answers in such a way that you're giving everything to the examiner on his plate. Do not, do not keep him guessing. Give him all the numbers in your answer paper. All right. I tell students sometimes, treat the answer paper as if you're teaching the examiner through your answer paper. So put on all the steps. Do not skip any steps, and also present it in a manner which is as methodical as possible. If you notice, what did we do over here? We did the IFHP part first, and within the IFHP part itself, we finished off pre-construction interest also. Then we had a part for PGBP, and then we gave the total number, the GTI number. So, divide your answer into various parts, give enough working notes. Do not be lazy to make those working notes. All right. So this is it with question number 10. Come to question number 11, the best question of the entire RTP. Question number 11 talks about a point which I've also covered in the MCQ discussion. So if you've already watched the YouTube video on the MCQ discussion, you would already be aware of the point, but anyways, we will be discussing over here again, irrespective. Let us read the question and then we will solve it. Again, they're asking us gross total income. Mr. Suresh has a sole proprietary manufacturing unit. Then the question says, one moment. Yeah. On 1st April 2022, he owns plant A and plant B. Depreciated value of the block on 1st April 2022 is 10 lakhs. So opening WDV they have given us. Then plant B is transferred on 15th October 2022 for 19 lakhs. Expenditure on transfer of plant B is 20,000. Plant C 15% is purchased on 10th March 2023. So we are purchasing another plant C. We are purchasing it in previous year 22-23, but it was put to use on 2nd September 2023. It was put to use only in previous year 23-24. Then what else? Business income of Mr. Suresh before claiming depreciation is 11 lakhs. Then they've given us information about capital gains. On 1st March, Mr. Suresh transfers 900 equity shares in A Limited for 23,50,000. Mr. Suresh does not own any residential property. Shares were purchased on 2nd April 2015 for 2 lakhs. To avail the benefit of exemption, he made some investments. They're asking us to find gross total income. All right. Very obvious. Looking at the question, how many heads are involved? Again, we have only 2 heads. Here we have PGBP and here we have capital gains. Okay, so we'll do it in the usual manner, just like how we worked out the question that we just did, question number 10. Same way, we'll have the first part for PGBP maybe. So part A, PGBP. Now under PGBP, they've already given us the business income of our assessee before depreciation. So write down business income in brackets before depreciation. How much is it? 11 lakhs. They haven't adjusted depreciation till now. They have given us all details about the block. So obviously they're expecting us to calculate depreciation. So write down less depreciation under section 32. We'll need a detailed working note for this. Give reference to working note number 1. Leave some 5 to 6 lines gap. Within the same part, open a working note. Give the heading depreciation. See, first of all, we'll have to do the block. Okay. How do we start the block? Opening WDV. So what is our opening WDV on 1st April 2022? In the beginning of the year, the question says our opening WDV here was 10 lakh rupees. So opening WDV, 10 lakh rupees. Then what do? We add something. What do we add? We add actual cost of assets acquired. Did we acquire any asset during the year? Yes. See, we had plant A and we had plant B. We sold plant B and then we acquired plant C. So do we have any asset acquired? Yes, we have plant C. For how much did we acquire it? We acquired plant C for 22 lakhs. Okay. Now, whenever we purchase a new asset, tell me guys, what are the rules I've told you? Whenever you purchase a new asset, whenever you have add actual cost of assets acquired, immediately there are 2 things that should come to your mind. What are those 2 things? Come on, tell me. I've already discussed them with you. Number 1, you will check whether 180 days condition is fulfilled or not. And number 2, one more thing, additional depreciation. You always check for 2 things, guys. Workout batch students, I hope you're able to recall all this. Yes, even yesterday we revised this again. So whenever I purchase a new asset, I always check whether it was put to use for 180 days or not. What do you think? In the current year, was it put to use for 180 days? No. In the current previous year, see, we're doing the calculation for previous year 22-23. In 22-23, was it used for at least 180 days? Forget about 180 days. It was not used at all. I used it only in 23-24. So in the current year, I haven't used it at all. So 0 days, no use at all. Guys, listen, if it is not even put to use, will it enter my block? Yes. See, once I acquire the asset, it will enter the block. Because I did not put it to use, see, I will not give depreciation, but it will enter the block. It is a part of the block now. I have purchased the asset. That is why if you see, what do you write over here? Actual cost of assets acquired. Do you write actual cost of assets put to use? No, right? So when does an asset enter the block? This is a very important learning, guys. This is the point which I was telling you I've discussed even in the MCQ part. So what is important? You acquired an asset. As soon as you acquire an asset, it will enter the block. I acquired the asset for how much? For 22 lakhs. I did not put it to use, so no depreciation, but it will enter the block. Why will it enter the block? Because I've acquired it. Now it is a part of the block. I will start claiming depreciation only when I put it to use. But it is a part of the block. I've acquired it. Hence, it will enter the block 22 lakhs. But I haven't put it to use at all. So 0 days. And will it be eligible for additional depreciation, guys? The additional depreciation, actually, it is eligible. But did you put it to use? No. So no additional depreciation in the current year. You can take it only in the next year. You're understanding? It is a 15% asset. It is not put to use, so no depreciation at all, but it will still enter the block because it has been acquired. You see actual cost of assets acquired. Is this point crystal clear? Yes, guys. Then after this, what do? You subtract, you less monies payable for assets sold. Have we sold any asset during the year, guys? Yes, we have sold plant B. We have sold plant B for how much? Plant B is transferred for 19 lakhs. So less money is payable for assets sold, 19 lakhs. And now what are we left with? We are left with 13 lakhs. And this 13 lakhs will be called closing WDV on 31st March 2023. Now guys, listen. What do I do with this 13 lakhs? I'm supposed to split this 13 lakhs. That out of this 13 lakhs, how much is the new asset plant C? I am supposed to set it apart, right? Why am I supposed to set it apart? Because on this plant C, no depreciation because it is not put to use at all. So no depreciation at all. So plant C is 22 lakhs. But tell me, do I have that much WDV left with me? Do I have 22 lakhs WDV left with me? No, I have only 13 lakhs. So this full 13 lakhs will come under plant C. Balance, do I have any WDV left? No. You might ask me then, ma'am, what about plant A? Plant A is still a part of the block, but then I am not left with any WDV. You might also ask me, ma'am, why shouldn't we do a proportionate splitting? No, you don't do proportionate splitting. You always apportion it towards a new asset first, only then balance. So my new asset is 22 lakhs. I have to set it apart because on this 22 lakhs, I shouldn't enjoy any depreciation. But do I have 22 lakhs of WDV left with me? No, I have only 13 lakhs. So only 13 lakhs I can apportion towards plant C. Balance, I'm left with nothing. Then after this, what do we calculate? Less normal depreciation. Will I have any normal depreciation, guys? Plant C, will I have any normal depreciation? No. Why no? No depreciation, as plant C was not put to use in previous year 22-23. So we will not have any normal depreciation. Balance is 0. So even here, no depreciation. If you notice, my assessee is a manufacturer. So which means I can think about additional depreciation. But will I have additional depreciation also? No, because same reason, the assessee has not put the plant to use. Plant C has not been put to use. So current year, you will get no depreciation. When will you get appreciation? Straight away in the next year only. Next year, do you have to think about 180 days? Tell me yes or no, everybody. Next year, do I have to check about 180 days? No, we check about 180 days only in the first year, only in the year of acquisition. Subsequent year, even if put to use for 1 day, I will still get full year's depreciation. Right, guys? I'll repeat again. Subsequent year, if it is put to use even for 1 day, I will get full year's depreciation. So next year, I don't have to bother about how many days I put it to use for. I put it to use for some days, I'll get full year's depreciation, full year's additional depreciation also in the next year. Okay, so guys, what is my total depreciation now? Total depreciation is 0. So what is going to be our opening WDV on 1st April 2023? 13 lakhs. And how much depreciation are we enjoying under section 32? 0. A very good question. Crystal clear with this, everybody? So depreciation is 0. So what is our PGBP now? 11 lakhs. This will remain our PGBP. All right, I'll wait for you. Just have a look at this working note once again. See if it makes sense to you. Any part of it, if you want me to repeat again, please let me know. Are we done? No questions? Crystal clear? Fine. So this was the biggest learning of today, that even though my asset is not put to use, it still enters the block. Not put to use, so no depreciation, but it will still enter the block. Okay, so we're done with the PGBP part. We're done till here. Now coming to the capital gains part. So write down part 2 or part B. Part B, capital gains. Let us give a reading to the capital gains adjustment once again. On 1st March 2023, Mr. Suresh transfers 900 equity shares in A Limited unlisted for 23,50,000. Mr. Suresh does not own any residential property. These shares were purchased on 2nd April 2015 for 2 lakhs. To avail the benefit of exemption under different sections, he made the following investments on 1st May 2023. He purchased a residential house property at Kolkata for 19 lakhs, out of which stamp duty expenditure is 30,000, and he purchased NHAI bonds for rupees 3 lakhs. Listen, you've read the question. No need to think too much. Straight away start off. What will your first step be? Capital asset. What is a capital asset in this question? Come on, tell me. Capital gains biggest problem is how to start. You've read the question, you've understood what happened, now start writing. What's a capital asset? The capital asset over here is 900 equity shares. A little more clearer, please. 900 unlisted equity shares. So the capital asset over here is 900 unlisted equity shares. The first step. Your second step should be the period of holding. When did you acquire these shares? You acquired these shares on 2nd April 2015, and when did you sell away these shares? On 1st of March 2023. This period is definitely more than 12, 24, 36. What is the relevant period for unlisted shares? 24 months. This is definitely more than 24 months. Therefore, what kind of an asset is it? This is clearly a long-term capital asset. Long-term capital asset. I'll put in brackets over here LTCA so that I can use this abbreviation later. Long-term capital asset. And which section will apply? LTCA, you generally have two assets, either 112 or 112A. Which section will apply over here? This is 112 LTCA. Why? Because unlisted shares. So you wouldn't have paid STT and all. So this is going to be section 112 LTCA. Then after this, we start off with the computation, right? Now, under the computation part, what is our first step? Our first step will be the full value consideration. For how much did we sell away the shares? We sold the shares for 23,50,000. They could have complicated over here by giving us the FMV number. Had they given us the FMV number, then unlisted shares, which section would you have applied? Had they given us the FMV of the shares, they are unlisted shares, we would have applied section 50CA. Had they given us the FMV, but they haven't given us the FMV, so good for us, no complication. I'll take 23,50,000 as it is. Okay. From this, what do we subtract? Expenses on transfer. To transfer these shares, any expenses that we read over here? No. But if you recall, when we were reading this part, we said plant B is transferred for 19 lakhs. Expenditure on transfer of plant B is 20,000. So did we forget something? Not really. See, in our block calculation over here, we do not bother about expenses on transfer. Expenses on transfer, where do we consider? We consider the expenses on transfer only in capital gains over here. You're understanding in depreciable assets, if you have expenses on transfer, please don't net off that against the full against the consideration. Like here, I shouldn't have netted off 19 lakhs and 20,000. I shouldn't have said that consideration money is payable is 18 lakh 80,000. No, because over here we are supposed to subtract money is payable, which means we're supposed to subtract the selling price. And what is the selling price? 19 lakhs, and that is what we did. So in depreciation calculation, in the block calculation, expenses on transfer plays no role at all. Is this clear? Did you grasp this? Yes, I'll repeat one last time. In block calculation over here, the expenses on transfer will play no role at all. Okay, so but then expenses on transfer do play a role in capital gains. Do we have expenses on transfer for the shares? Nothing at all. So this 23 lakh 50,000 also becomes our net consideration. Okay, then what do we subtract after this? Cost of acquisition. Pause, check. Remember guys, is it long-term capital asset? Section 112A acquired on or before 31st Jan 18. Had it been long-term capital asset, section 112A, acquired on or before 31st Jan 18, then what would you do? You would do the drama calculation for cost of acquisition where you compare with FMV, FPC and all that. But here, it is not 112A first of all. It is section 112. 112 normal, usual capital gains, guys. So I can index the cost of acquisition. Yes, I can index the cost of acquisition. Had it been 112A, then you would have applied all that drama of not indexing, instead comparing with FMV and all that. So, but then here it's 112, so I'll take the index cost of acquisition as it is. Now, what is the cost of acquisition? The question says we had acquired the shares for 2 lakhs on 2nd April 2015. Now, what's the formula for indexing the cost of acquisition? The formula is cost of acquisition into CII of the year of transfer divided by CII of the year of acquisition. Okay, so applying the formula, what is our cost of acquisition? Our cost of acquisition is rupees 2 lakhs into CII of the year of transfer, which is given to us in the question 331, divided by CII of the year of acquisition, which is also given to us in the question 254. How much does this work out to? Do you get this number? 2,60,630. Yes, this is going to be our indexed cost of acquisition, guys. And then after this, what else do we subtract? Indexed cost of improvement. Obviously, they are shares, so we will not have any cost of improvement and all. So what is the long-term capital gain as of now? What is our LTCG as of now? 23 lakh 50,000 minus 2 lakh 6630. You will get 20 lakhs 89,370. Okay, till here we have handled. Now what else do they say? Our assessee is making these purchases. He buys a residential house property at Kolkata for 19 lakhs. Guys, he's selling long-term capital asset shares, not being house property, and he's buying another house property, and he also does not own any other property. So which section comes to your mind? Section 54 exemption I can give, guys. So less Section 54F exemption, we'll have to give a note on this. So give reference to working note number 2, leave some 3 to 4 lines gap and open your second working note with the heading Section 54F. See, do not blindly take the exemption, okay? See whether the conditions are fulfilled. What are the conditions here? Is your assessee an individual or HUF? Yes, he's an individual. So assessee is an individual or HUF. He is an individual. Then what else? What are we supposed to transfer? We're supposed to transfer any long-term capital asset other than residential house property. We did exactly that. We transferred equity shares. So write down after this, assessee has transferred long-term capital asset not being residential house property. And what are you supposed to buy? And he acquired one residential house property in India. Did he acquire it in India, guys? Yes, in Kolkata. Condition fulfilled. Yes, then he should have acquired within how long? I mean, what's the period over here? He should have acquired within 1 year before transfer or 2 years after transfer, or if he's constructing, he should have finished the construction within 3 years from transfer. Did he do that? See, when did the transfer happen? The transfer happened on 1st March 2023. And when did he acquire? On 1st May 2023. So in just a few months itself, he has done the purchase. So write down the new asset was acquired within 2 years from transfer. Now tell me, guys, Section 54 exemption, what is the rule that I've taught you? Before you claim Section 54 exemption, what are you supposed to check? You're also supposed to check that did you purchase within 139(1) due date also? Why, guys? Amazing answers. Who's giving me all these perfect answers? Nahala, amazing. Every single answer perfect. Loving the clarity, Nahala. Listen, the new asset was acquired within 2 years from transfer. You cannot stop with that. You also have to check whether my assessee has invested within 139(1) due date. Why? Because had he invested after 139(1) due date, then what would we have required? CGTAS. Right, guys? So that is why we take it as a rule that when we come to 54 exemptions, we also check, apart from everything else, that it was the investment made before 139(1) due date. We made the investment in May 2023 itself, guys. We're doing the calculation for assessment year 23-24. Earliest possible 139 due date is what? Earliest possible 31st July 2023. We have made the purchase even before this date. Hence, it's definitely going to be valid. We have purchased within 139(1) due date. So the new asset was acquired within 2 years from transfer. Also, it was acquired before Section 139(1) date. And one more thing, if you remember in Section 54F, there are some more conditions. Like, for example, my assessee should not be owning any other property apart from the new property which he is purchasing. And even that condition is fulfilled. The question says over here, Suresh does not own any residential property. So, assessee does not own any other residential house property. So all conditions fulfilled, guys. We have to tell the examiner that we checked all these conditions, individual or HUF. He transferred long-term capital asset not being house property, and he purchased a residential house property. He purchased within 2 years from the date of transfer. He also purchased within 139(1) due date. He does not own any residential property. All conditions fulfilled, guys. Hence, my assessee is eligible for 54F exemption. Yes, so write down as all the conditions are fulfilled, assessee can avail exemption. Assessee can avail exemption under Section 54F as follows. Now, I straight away can't claim the exemption. Do you remember we have a formula? Right? What is the formula? What's the basis for the formula? See, had I invested the entire net consideration, then I would have gotten full 28,89,370 exemption. But how much did we invest? We invested only 19 lakhs. So proportionate exemption only we will get. What's the formula for the proportionate exemption? Amount invested in the new asset. Amount invested in the new asset into capital gains into LTCG divided by net consideration. So, how much amount did we invest in the new property? 19 lakhs. And what is our LTCG before exemption? 20,89,370 divided by what is our net consideration? 23,50,000. So do your math. What is a 54F exemption? Do you get this number? 16,89,278? Yes, perfect. Section 54F exemption, guys. The formula you have to use, proportionate exemption you give for 54F, 16,89,278. Okay, this is also done. Now, after this, there's one more thing our assessee is buying. He's buying bonds. When you buy bonds, which section do you think about? You think about 54EC exemption. Okay, give reference to working note number 3. After your second working note, open working note number 3. Give the heading section 54EC exemption and tell me, will I give my assessee 54EC exemption? When does 54EC exemption come into the picture? If my assessee has sold land, building or both and he buys bonds. But did he sell land, building both here? He has sold equity shares. So will 54EC apply here? No. So write down as the asset being transferred, is not land or building or both. Section 54EC exemption is not available. So 54EC exemption 0. So what will be our taxable LTCG now? That's going to be 4,92,000. Do we get this number? What did they ask us? The gross total income. We've done two parts. Our first part was PGBP. PGBP was 11 lakhs. Our second part, capital gains, 4,92,000. Now your final part, part 3, which will be your gross total income calculation. How much will this be? Your gross total income calculation will be nothing but your two heads. First of all, you have PGBP, 11 lakhs. And then you have capital gains. This capital gains is nothing but LTCG under section 112. You just calculated 4,92,000. So what will our gross total income be? 15,92,000. Tell me, do I have to round this off? No. What do we round off? We round off total income and tax, but this is only gross total income. They asked us only gross total income. Gross total income, we don't round off. Right, guys, got it? A very good question. Our biggest learning in this question was that WDV, that the block calculation. All right, shall we close this question? Shall we go to the next question? The next question will be like a easy, simple question, guys. Set off and carry forward, a very simple question. Come on, let us go to question number 12. Let's read the question and then we'll work out. Mr. Ram, a resident individual aged 65 years. What can I conclude? He is a resident individual aged 65 years. I can conclude he's a senior citizen, guys. Just because of his age, I can't conclude he's senior citizen. He's a resident individual at least 60 years. I'll call him senior citizen. He submits the following information. By looking at the question itself, we are able to identify this is a set off and carry forward question. Yes, then what are they asking us? Compute total income of Mr. Ram and show the items that are eligible for carry forward, assuming he does not opt for provisions under section 115 BAC. Now, set off and carry forward. Again, here, everybody has their own method of solving these questions. I'll show you what is a method that I generally suggest. All right, then you can follow whatever method you want to. They're asking us to find the total income of the assessee. All right, first of all, I'll make my table. I'll give my heading first, computation of total income. Computation of total income of Mr. Ram. For which year are we calculating? Assessment year 23-24, in brackets previous year 22-23. Okay. Make a table now, a broad particulars column, and you will need 3 amounts columns. Why? There's no specific reason as such. I ask you to make 3 amounts columns in every set off and carry forward question because there is no format in which you solve a set off and carry forward question. So if you have many amounts columns, you can properly space out your answer and you can present it properly. Otherwise, it becomes too clumsy, it becomes too hodgepodge. Okay. So when you, especially in set off and carry forward questions, draw multiple amounts columns so that you can, clearly show the flow to the examiner. Now we'll start reading the question. Do not forget my assessee is a senior citizen. Okay. Loss from speculative business. All losses I will handle separately. I will make a rough note for myself in the answer paper on the margin. All right. And here I'll keep writing all my losses. Number 1, we have loss from speculative business. So we have speculative business loss of 30,000. All losses I will handle separately. It's okay. I'll write them in the margin over here. At the end, I will remember to strike this off so that the examiner doesn't get confused what all this kachra is. I cannot do all the marking in the question paper because you know very well in the question paper, we're not allowed to write or mark anything at all. So that is why I will not do all this writing here. Instead, I will do in my margin to help me out to make it easier for me. Then we have income from speculative business B. This is going to the head PGBP. So under particulars, we will have PGBP. Under this, speculative business income. How much is it? Business B, speculative business income is 1,50,000. Then loss from specified business covered under 35 AD. So we have another loss. Losses we'll handle separately. 35 AD business loss is how much? 20,000. Then income from salary computed. Good thing it's computed. We don't have to handle standard deduction. Leave some gap, maybe some 5 to 6 lines gap. Then another heading, salaries. Under salaries, what is the number that they have given us? 2 lakhs. Then income, loss from let out house property. So loss from house property is 1,90,000. I'll handle it later separately. 1,90,000. Then we have loss from cloth business. So we have another business loss, but cloth business, so it is non-speculative business loss, and that is 80,000. Then we have long-term capital gain from sale of urban land. Guys, LTCG. What kind of LTCG is this? This is clearly section 112 LTCG, guys, because it is from sale of land. So 112 LTCG, 3 lakhs. Had it been, listed equity shares, FCT paid and all, I would have spoken about 112A. Then long-term capital loss, sale of shares, STT not paid. So what kind of LTCL is this? STT is not paid. This is section 112 LTCL. How much? 1 lakh. Then what else? We have another long-term capital loss, sale of listed shares in recognized stock exchange. STT paid at the time of acquisition and transfer. LTCL, STT paid. So what kind of LTCL is this? 112A LTCL, 1,50,000. Then what else? We have income from betting, 80,000. Which head will this go to? IFOS. So I'll open another head, IFOS. Under this, we have betting income. Betting income 80,000. Guys, I hope you've identified this is casual income. I will not adjust any loss against this. Then we have loss from gambling. What do we do with gambling loss? No doubt we're supposed to ignore, but for now we'll write it over here because all losses we are going to handle separately. So gambling loss 8,000. Then we have interest on saving bank deposits. So even this will go to our IFOS head. So we have savings bank interest. How much? 12,000. And then we have interest on FD with banks. We have FD interest. of 40,000. Guys, savings bank interest, FD interest, does any section come to your mind? Are you thinking about something? She's senior citizen. So which section are you supposed to think about? ATTTB, right? Senior citizen, you will think about ATTTB because ATTTB is much more beneficial than ATTT. ATTTB is only for senior citizens. So ATTTB is something which I have to handle at the end. I'll make a note of that also over here. Okay, so we've handled all the points over here. Now let us start off with our set of game. In the set of game, what's the first thing we do? We always do intra-head adjustment first within the same head. We'll go one by one. Speculative business loss. What's the rule? We can adjust against what? Speculative business loss, I can adjust only against speculative business income, and I have speculative business income. So I can adjust over here less speculative business loss. How much is it? 30,000. I will adjust this fully over. Then I have 35AD business loss. What is my rule about 35AD business loss? This I am allowed to set off only against 35AD business income. We've seen the entire question. Do we have 35AD business income? No. So I can conclude that this I'm going to carry forward, guys. We can carry this forward for how many years? Indefinitely. We can set it off against what? We can set it off only against 35AD business income. Right? Who is saying any? We can set it off only against 3580 business income. Only unabsorbed depreciation, unabsorbed expenditure on family planning, unabsorbed capital expenditure on scientific research. Only these three you can adjust against anything. But 3580 business loss, see, listen, I'll give you a small comparison. When you talk about 3580 business loss and when you talk about unabsorbed depreciation, unabsorbed capex on scientific research and all that, there is a similarity. What is a similarity? That I can carry them forward for any number of years. I can carry forward both indefinitely. Both I can carry forward for any number of years. But what is the difference? There are two differences, guys. Difference number one, 35AD business loss, you can set off against what? You can set off only against 35AD business income. But unabsorbed depreciation, you can set off against what? You can set off against any head of income except salaries. Okay. And there is one more difference. 35AD business loss, if you filed your ITR late, then can you carry forward 35AD business loss? No. If it is section 139(4) return, that is if you filed your return late, you cannot carry forward 35AD business loss. But unabsorbed depreciation, even if you filed your ITR late, you can still carry forward. So therefore, even if you have filed 139(4) return, even if you are filing late return, you can still carry forward unabsorbed depreciation. A lot of times students have a wrong understanding because both indefinitely, so they think exactly the same. No, there are two differences. Are we all crystal clear with the differences, guys? 3580 business loss I can set off only against 3580 business income. Unabsorbed depreciation I can set off against anything except salaries. 3580 business loss I can't carry forward if I file my return late. But unabsorbed depreciation, even if I file my return late, I can still carry forward. Tell me, what is the other loss which you can carry forward even if you file your return late? One more loss which you can carry forward even though you filed your return late? Loss from house property. Perfect. All right. So coming back to my answer now, 3580 business loss I'm going to carry forward because I don't have any 3580 business income. Now, what about loss from house property? What are the things I can adjust this against? I can adjust this. First of all, I will try intra-head. Is intra-head possible? We're doing only intra-head right now. Intra-head is not possible. I don't have any income from house property. Then I have business loss non-speculative. Is intra-head possible? Yes, I still have income left over here. I still have 1,20,000 left over here. Against this 1,20,000, I can adjust non-speculative business loss. Tell me, can I adjust non-speculative business loss against speculative business income? Yes. See, I have speculative business income. I have non-speculative business income. I have speculative business loss. I have non-speculative business loss. Okay, speculative business loss I can adjust against what? Only against speculative business income. Non-speculative business loss I can adjust against what? Both. Against speculative business income also, against non-speculative business income also. So here we have non-speculative business loss, which we can adjust against speculative business income. How much is a non-speculative business loss? 80,000. Fully I can adjust over here. So this is fully done. Then we have long-term capital loss, 112 and 112A. Totally we have 2,50,000. Tell me, should I differentiate between them? No. Whether 112, whether 112A, I'll consider fully. Am I supposed to think about 1 lakh exemption and all? No. And 1 lakh exemption is number one only for capital gains, and that too only when you're calculating tax liability, not when you're calculating total income. So over here, I'll handle the loss. I'll handle both the losses. Number one, we have section 112 long-term capital loss of how much? 1 lakh. And number two, you also have section 112A long-term capital loss of how much? 1,50,000. So both my long-term capital losses I have adjusted. You know LTCL we can adjust only against LTCG. Both of these are adjusted. Gambling loss, what will I do? I will simply ignore the gambling loss, right? Gambling losses are ignored. Losses from betting, gambling, card games and all you ignore. We're done with intra-head adjustment. Now we'll step into inter-head adjustment. Only one loss we are left with, which is loss from house property. Play a little smart here. PGBP, we still have 40,000 PGBP left. Okay, I can adjust my loss from house property against PGBP. I can adjust it against salaries. Here I have 2 lakhs. Capital gains, I still have 50,000 left. I can adjust against capital gains also. In IFOS, see, I can't adjust against betting income, but against these two incomes, I can adjust. So I have so many options. I can adjust against PGBP, against salaries, against capital gains, against IFOS. But which of these will I choose? If you look at the total income of my assessee, if you look at the normal rate income of the assessee, 40,000, 2 lakhs, and these numbers, if you see, it is definitely not crossing 5 lakhs. So what will be the tax rate of my assessee for these normal incomes? For these normal incomes, it's going to be not more than 5%, guys. Do you agree? Because it's not going to cross 5 lakhs. So if you look at the slab rate, up to 5 lakhs, 5% only. And there you get 87A rebate benefit and all. So clearly looking at, see, the situation that we are in right now, the other income taxation rate will be only 5% maximum. But we have 112 LTCG 50,000. Here, what will the tax rate be? 20%. So other incomes tax rate only 5% because not exceeding 5 lakhs. But LTCG 50,000 will be 20%. So the loss from house property, I will definitely prefer to adjust against what? Against capital gains. Right? So I have loss from house property 1,90,000 I have. How much I can adjust? I can adjust the, I have 1,90,000, at least 1,50,000 I can adjust over here. No, I have 50,000 only left, right? 2,50,000, I have only 50,000 left. So loss from house property, at least 50,000 I will adjust over here. I will give first priority to capital gains because 20%. So capital gains I'm left with is 0. Loss from house property, I still have 1,40,000 left. I hope you are aware, loss from house property inter-head, maximum how much can you adjust? Inter-head. Only 2 lakhs. We are anyways not crossing 2 lakhs. Now we have 1,40,000 left. 1,40,000 I have PGBP, I have salaries, I have IFOS. Here I'm going to be indifferent because all the 3 normal rate incomes. So let us say I adjust against salaries. The balance loss from house property, which is 1,40,000. So how much am I left with? I am left with 60,000 here. So 40,000 PGBP, 60,000 of salaries, capital gains 0. And IFOS of 1,32,000. Totally, this gives me gross total income of how much? What is my gross total income? 1,32,000 plus 60,000 salaries plus 40,000 PGBP. Do you get 2,32,000, everybody? Yes, and then do you remember we had chapter 6A still left, loss from house property handled fully. We still had chapter 6A 80 TTB left. Now, can I straight away calculate chapter 6A? No. What am I supposed to do? I'm supposed to split this into 2 parts. What is my normal rate income? What is my special rate income? Why do I do that? Because chapter 6A is only against normal rate income and not against my special rate income. So what are my special rate incomes, guys? Capital gains has anyways become zero. So the only special rate income I have is betting income. Capital gains income has already become zero. So the only special rate income I have right now is 80,000, and everything else is my normal rate income, 1,52,000. Now I'll think about chapter 6A. We had spoken about ATTTB. Tell me, does ATTTB allow savings interest? Yes. Does it allow FD interest also? ATTTB. Yes, ATTTB allows FD interest and savings interest. ATTTA allows only savings interest. Okay. And total is 52,000, but maximum how much I can allow? Under ATTTB, maximum 50,000. So here I am left with 1,02,000. Here I am left with 80,000. So what is the total income of our assessee? 1,82,000. This becomes the total income. That is what they had asked, total income. We have found the total income, 1,82,000. Are we crystal clear? Yes. In addition to this, they also asked us what are the losses that we are going to carry forward. What are the losses that we're going to carry forward, guys? We've already spoken about it. Gambling loss, we have to ignore. Only 35 AD business loss we will carry forward. So write down over here, section 35 AD business loss, rupees. What's the amount? Here, 20,000 shall be carried forward indefinitely to be adjusted only against income from specified business. Next point, write down gambling loss to be ignored. Gambling loss to be ignored. Crystal clear, guys? Any questions? Perfect understanding. Can I proceed forward? Yes, so this was it about question number 12, a good question on set off and carry forward. All right, guys. So we also had a very good learning on 35 AD business loss and unabsorbed depreciation. This difference we've seen. Let us close this question. Let us come to the next question, question number 13. Question number 13 is a very, very simple question on clubbing. All right, let us read this. It is, I would say that the only reason why we are even discussing about this question is this one adjustment. Otherwise, everything else is perfectly easy. All right, see, what are we left with? I hope you're not losing your patience. We have to finish question 13, a simple question. Question number 14 is your total income question. And we have a very small question, question number 15 from assessment procedures chapter. So we have 3 questions left. Let us finish them one by one. Talking about question number 13. Examine the tax implications of each transactions and compute the total income of Mr. Tushar and Mrs. Tushar and their minor son for assessment year 23-24. They're asking us, number 1, examine the tax implication of each transaction. So we have to write some theory also, and then they're asking us to compute total income. All right, of whom? Of Mr. Tushar, Mrs. Tushar, and minor son for assessment year 23-24. We do not wish to opt for 115 BAC. So each transaction, first we have to examine, then total income. What's the first transaction? Mr. Tushar has a fixed deposit of 6 lakhs in SBI. He instructed the bank to credit the interest on the deposit at 9% from 1st April to 31st March to the savings bank account of Mr. Raj, son of his brother, to help him in his education. What has happened here? Mr. Tushar did not transfer the FD. He only transferred income from the FD to Mr. Raj, who is son of his brother. This is clearly the case of transfer of income without transfer of asset. It doesn't matter to whom I'm transferring. It doesn't matter whether this is relative, non-relative and all. Transfer of income without transfer of asset, clubbing will be attracted. They asked us to examine the provisions. So first we will write our provision, write down when assessee transfers income without transfer of asset, comma, the income so transferred, in brackets write down, revocable or irrevocable, the income so transferred will be clubbed with the income of the transferor. Will be clubbed with the income of the transferor. Okay. Continue writing. In the given case, Tushar transferred FT interest without transferring FT to Raj. Hence, FT interest will be clubbed with Tushar's income. So first we've done the examination of the first adjustment. Now coming to the second adjustment, the star adjustment of this question. Mr. Tushar started a proprietary business on 1st May 2022 with capital of 6 lakhs. His wife, Mrs. Tushar, a software engineer, gave cash of 5 lakhs on 1st May 2022, which was immediately invested in the business by Mr. Tushar. He earned a profit of 4 lakhs during previous year 22-23. What about this? See, his wife, Mrs. Tushar, has given him cash of 5 lakhs on 1st May 2022, which he has put into the business. You know very well that when I transfer anything to my spouse for no consideration or for inadequate consideration, then whatever income my spouse earns from that asset will be clubbed into my hands. Here, if you see, Mrs. Tushar has given to Mr. Tushar how much? 5 lakhs cash. This 5 lakhs cash is a transferred asset. This 5 lakhs cash has changed form into investment in business, guys. What is the provision? If I transfer anything to my spouse for no consideration or inadequate consideration, from that transferred asset, if my spouse earns any income, it will be clubbed with my income. Now, the transferred asset may be in the same form or different form. The transferred asset is 5 lakhs cash. This has changed form into investment in business. So from this transferred asset in same form or different form, from this, if Mr. Tushar is earning any income, it will be clubbed with Mrs. Tushar's income. Here, guys, please notice Mrs. Tushar is transferring to Mr. Tushar. So the clubbing will happen with Mrs. Tushar's income. How much did she transfer? She transferred 5 lakhs. And what did Mr. Tushar do with it? He put the money into business. So 5 lakhs transferred asset has converted into investment in business. Now from the business, whatever profit Mr. Tushar is earning, proportionately it will be clubbed with Mrs. Tushar's income. But in business proportions, we have a formula which I hope you remember. We're supposed to see on the first day of the year, guys. Yes, so listen, first of all, let us write down the theory. Write down income. No, wait. Write down if assessee transfers an asset in brackets other than house property. Why other than house property? Because when you transfer house property to your spouse, you apply deemed owner concept under IFHP. You don't apply clubbing concept. If I transfer a house property to my spouse for no consideration or inadequate consideration, there I will apply deemed owner concept under IFHP and not clubbing. So if assessee transfers an asset other than house property to his or her spouse for no consideration or inadequate consideration, comma, income earned by the spouse from such asset in same form or different form shall be clubbed with transferor assessee's income. Shall be clubbed with transferor assessee's income. Understood, everybody? Yes, so this is it about our discussion regarding this particular point. When assessee transfers income without transfer of asset, the income so transferred will be clubbed with the income of the transferor. This was transfer of income without transfer of asset. Here, I am transferring an asset to my spouse for no consideration or for inadequate consideration. Then income earned by the spouse from the asset in the same form or different form shall be clubbed with the transferor assessee's income. This is a provision. Now let us apply this provision in our case. Write down in the next line. In the given case, Mrs. Tushar has transferred rupees 5 lakhs. Has transferred rupees 5 lakhs to Mr. Tushar for no consideration. From no consideration. The transferred asset rupees 5 lakhs of cash has changed form into investment in business. Now, income from such business will be proportionately clubbed with transferor Mrs. Tushar's income. Income from such business will be proportionately clubbed with transferor Mr. Tushar's income. Did you understand what you've written? You've written quite a lot. We first wrote down the provision, guys. I am transferring asset to my spouse. No consideration, inadequate consideration. Now my spouse, whatever income he earns from this asset, same form or different form, will be clubbed with my income. Then I simply applied that provision in this case. In this case, Mrs. Tushar has transferred cash to Mr. Tushar for no consideration. And what did Mr. Tushar do with the money? He changed form into investment in business. Now, from this investment in business, whatever income we get, proportionately it will be clubbed. Now, what is the formula? How do we do the clubbing? Write down. Income to be clubbed is equal to net profit from the business into investment in business out of money transferred by Mrs. Tushar. We're supposed to see the numerator and denominator on the first day of the previous year, right? See, the first day of the previous year would be 1st April 2022. But see, we started the business itself on 1st May 2022. So for us, the first day of the previous year will become 1st May 2022. So on 1st May 2022 divided by total investment in business on 1st May 2022. This numerator and denominator you're supposed to take on the first day of the year. But when I start my business during the year, then obviously for that business, the previous year will start only when I started the business. So 1st May 2022. Now, what is the net profit from the business, guys? The net profit is 4 lakhs from the business into what is the investment out of money transferred by Mrs. Tushar? She had transferred 5 lakh rupees on 1st May, and that money was immediately invested in the business on 1st May itself. So the money invested out of Mrs. Tushar's money is 5 lakhs divided by total investment is how much? Mr. Tushar started a proprietary business with capital of 6 lakhs. This 6 lakhs plus his wife gave him 5 lakhs. Even this 5 lakhs was put into the business. So what is the total investment in the business on 1st May? 11 lakhs. All right, guys. So now if you calculate what is the PGBP to be clubbed, you will get 1,81,818. This is the income which you will club. To be clubbed with whose income? To be clubbed with Mrs. Tushar's income. So what about the balance? What about the income to be taxed as Mr. Tushar's income? How much will be Mr. Tushar's income? The balance. Total net profit is 4 lakhs. Okay. Out of this 1,81,818 we are clubbing. So how much balance are we left with? We are left with 2,18,182. This is how much will be taxed as Mr. Tushar's income. Okay, so we used our formula, net profit from the business, net profit for the year into amount invested in the business out of transferred asset in the first day of the year. Here, instead of first day of the year, I will take when I started the business divided by total investment in the business on the first day of the year. Please don't forget numerator and denominator, both first day of the year. But because I'm starting my business in between the year, for that business, the previous year will start whenever I start the business. So 4 lakh into 5 lakh by 11 lakh, 1818 I will club with Mrs. Tushar's income. The balance profit will be taxed as Mr. Tushar's income itself. Crystal clear with this, everybody, guys. A very good adjustment. Are you able to absorb this? We have written it properly, just like how you will write in the examination, guys. All right. Now, after this, coming to one last adjustment. That is simple. Nothing to worry here. What does it say? It says Mr. Tushar's minor son derived an income of 20,000 through a business activity involving application of skill and talent. Generally, minor children's income we club, but if the minor children is earning income from skill and talent, labor and all, do we club? We don't club. So here it is because of skill and talent, hence we will not club. So write down income earned by minor children is clubbed with income of the parent with higher income. But income earned by minor children applying skill and talent shall not be clubbed. Shall not be clubbed. Write down, therefore, business income of Tushar's minor son shall not be clubbed. We wrote all this drama over here because they were asking us to examine the tax implication. We've done this. Now they're also asking us to compute the total income. So give the next heading, computation of total income Make a 3-columnar table, a broad particulars column, 1 column for Mr. Tushar, 1 column for Mrs. Tushar, and the last column for minor son. Okay, we've already done the analysis, so we don't have any thinking left to do. This FD point, what did we learn? FD interest, even though it is going to Mr. Raj, we're going to club it with Mr. Tushar's income. What is the amount? The amount is 6 lakhs into 9%. Show the calculation, please. 54,000. We will club it with Mr. Tushar's income. We've already discussed transfer of income without transfer of asset. We will club. FD interest. So does any section come to your mind? FD interest, ATTB is supposed to come to your mind, but the question does not say he's a senior citizen, so I can't apply ATTB. Also, ATTTA I can't apply because FD interest is not covered by ATTTA. Okay, then after this, we have our next income, which is business income. Business income, we have already done the calculation. In Mr. Tushar's hands, only 218,182 will be taxed. In Mrs. Tushar's income, the balance will be clubbed 181,818. Then finally, even minor son is having business income 20,000. Here we said no clubbing, so he will pay tax himself. So what is the total income of each assessee now? Total income. Mr. Tushar's total income will be 2,72,182. Mrs. Tushar's will be 181,818 and minor son's will be 20,000. Perfect understanding? Yes, any questions? Gaining the clarity, guys? Yes, so with this, we are done with this question as well. We've properly examined the tax implications. We wrote our notes and then we also did the computation of total income. All right, can we close this question? Can we start question number 14 now? Question number 14 is a total income question, guys. Your full-fledged total income question. Adjustments over here, if you see, they are simple, bearing 1 or 2 adjustments. The rest of it is a very simple question, total income question. Do not be overwhelmed looking at the size of the question. It's fine. We will be able to handle it. Let's see what the question is telling us. Mr. Kamal, a resident individual aged 48 years. So what are we going to think of? Not a senior citizen. He is working at a senior management position in a private bank since 20 years. During the year, he received the following emoluments from employer. They've given us a lot of information. Following transactions were made by Mr. Kamal during the year. Again, they've given us transactions. Compute total income and tax liability for the assessment year. Ignore 115 BAC. So as we read the question, we'll keep doing unnecessary working notes. All right. So answer to question number 14, give the heading computation of total income. Computation of total income of Mr. Kamal. We are calculating for previous year 22-23 in brackets assessment year 23-24. Make a 3-columnar table, a broad particulars column, then 1 column for working note, and finally a column for amount. Okay, this is the method in which I'm going to be solving the question for you. The same way I'm going to think and solve even in the examination. As I keep reading adjustments, wherever working notes are required, I'll open then and there. That way, I don't have to keep too many things in my mind. I don't have to retain any information. As I keep reading one by one, I'll keep doing the necessary adjustments. He is receiving the following emoluments from employer. We have salary and all. So obviously, my assessee has a salaries head. So under particulars, write down salaries, give reference to working note 1. Leave easily 7 to 8 lines for total income calculation. Again, leave some 8 to 10 lines for tax liability calculation. And then start the first working note with the heading salaries. Under this, first of all, we have basic salary 3,50,000 per month. So basic salary, please show the calculation 3,50,000 into 12. which is going to be 42 lakhs. Then, client entertainment reimbursement of 20,000 per month, out of which he submitted bills for 2 lakhs for the relevant year. This is not entertainment allowance. This is a perquisite, reimbursement of entertainment expenditure. So he was reimbursed 20,000 per month, but how much did he actually spend? Only 2 lakhs. So received minus whatever he spent, balance taxable. Simple. It is not entertainment allowance, guys. It is entertainment perquisite. So entertainment bills reimbursed. Show the calculation here itself. We received 20,000 per month. So 20,000 into 12, we received 2,40,000 plus amount spent for official purposes. The question says he submitted bills for 2 lakhs. So amount spent for official purposes, 2 lakhs. So the balance 40,000, this is going to be taxable. Simple adjustment. Then leave travel allowance 4 lakh per annum. He took a trip to Goa with his spouse and 2 children. Good, only 2 children allowed. In December 2022, for which plane boarding tickets of 1 lakh and hotel booking of 3 lakhs were submitted to the employer. See, listen, we're talking about leave travel allowance. How much did he get? He got leave travel allowance. Received was 4 lakhs. But listen, how much will be exempt? Whatever you spent for travel, only that will be exempt. Hotel booking and all will not be exempt. So leave travel allowance, you got 4 lakhs, but only to the extent of the travel expenditure. Only the travel expenditure will be exempt for you. So less amount spent on travel. And one more thing, you're supposed to travel only to any place in India. Yes, he went to Goa. And you're supposed to go with your family. Yes, he's gone with his spouse and 2 children. Number of children should not be more than 2. Yes, it is 2 children only. So I will give exemption, but only to the extent of the travel. The hotel expenses are not allowed. So write down less hotel expenses. In brackets, write down not exempted. So here 0. So how much will be taxable? 3 lakhs of leave travel allowance will be taxable. Whatever you are spending for travel, only that will be exempt. The balance is going to be taxable. Then performance bonus, 20% of salary. So he's also getting bonus. Show the calculation. It says 20% of annual basic salary. Our annual basic salary is 42 lakhs. So 42 lakhs into 20%. This is going to be 8,40,000. Done. Then he is eligible to take a staff housing loan up to 20 lakhs at a concessional rate of 2.5% per annum. So he has eligibility to take 20 lakh loan, but he took how much loan? He availed a housing loan of 15 lakhs out of the same. On 1st June 2022, he took the loan. No repayment of the loan has been made during the year. Lending rate of SBI on 1st April 2022 for housing loan is 8%. Now tell me, is the aggregate original amount up to 20,000? No, the loan amount is more than 20,000. Is the loan amount for the purpose of treatment of disease? No, it is for the purpose of taking a housing loan. So first of all, this is a taxable perquisite, guys. Yes, so it is taxable perquisite. And how much interest are we paying? 2.5%. But what is SBI lending rate? SBI lending rate is 8%. So clearly we are getting a benefit. How much benefit are we getting? What is the difference? The difference of 5.5 we're getting as a benefit. So that's going to be a taxable perquisite. So write down over here the next point. Loan at concessional rate of interest. See, loan is not the benefit. The concessional interest, that is a benefit. So how much concession are you enjoying? 15 lakhs loan you took, okay. 5.5% concession you are enjoying. How did you get that 5.5%? The SBI lending rate is 8% minus what are you paying? 2.5%. So this is the concession you are enjoying. You took the loan only on 1st June. So you're going to calculate only for 10 months. How much is this going to be? Do you get 68,750? That's going to be the taxable value of the perquisite, guys. 68,750. In brackets, also write down as the loan amount exceeds rupees 20,000, and also it is not for medical treatment, comma, the perquisite is taxable. By writing this, we are telling the examiner that we've thought about both these points. It is more than 20,000. It is also not for medical treatment. Therefore, the perquisite is taxable. So we saw the concession. To the extent of the concession, it's going to be taxable. We've taken this loan for what, by the way? We've taken this loan for the purpose of a housing loan this is. Then, the bank also allotted 1,500 sweat equity shares to Mr. Kamal in May 2022 at the rate of 1,300 per share. FMV of the share was 1,500 per share on the rate of exercise of option by Mr. Kamal. That has handled till here. So our next adjustment is sweat equity shares. Now, sweat equity shares, there are two things which you have to remember. First of all, what is taxable? The FMV on the date of exercise of option minus whatever you paid, the difference is going to be taxable. But it will be taxable when? In the year of allotment. When were the shares allotted? Allotted in May 2022, current year. So current year there will be taxation, but how much? The difference. The FMV is 1,500, but we are paying only 1,300. So we're getting a benefit of 200 rupees per share. This 200 rupees per share will be taxable in the year of allotment. So we have to write all that theory also. So write down under sweat equity shares, FMV minus exercise price, that is, guys, please make a correction. FMV, write down FMV on the date of exercise of option. FMV on the date of exercise of option. It is important that you mention this, okay? So FMV on the date of exercise of option less exercise price. That is, what is the FMV on the date of exercise of option? 1,500 minus exercise price 1,300 rupees. 200 per share will be taxable in the year of allotment. Allotment happened in May 2022. That is previous year 22-23. Total taxable perquisite is equal to rupees 200 per share into how many shares? Into 1,500 shares. So 200 into 1,500, 3 lakhs. This is going to be your taxable value for sweat equity shares. You've written your theory that FMV on the date of exercise of option minus exercise price will be taxable, but it will be taxable when? Only in the year of allotment. And in the current year, allotment happened. So current year, 200 rupees per share will be taxed for totally 1,500 shares. And what else does the question say? He sold all the shares for 2,100 per share. Guys, he sold the shares. So which head will be attracted now? He sold the shares. Capital gains will be attracted. So come back to your main answer. Write down capital gains and give reference to working note 2. After first working note, leave some gap of 7 to 8 lines. Open working note number 2 with the heading capital gains. What does the question say? He sold all the shares for 2,100 per share on 31st March 2023 on a recognized stock exchange. Assume STT has been paid. STT has been paid at the time of transfer. Capital gains, what did I tell you? What's the first thing I always check? The capital asset. What is the capital asset in the question? What are we selling? We are selling sweat equity shares. Give me some more clarity. Can I say they are listed sweat equity shares? Because they are sold on stock exchange, guys. Yes. So I am selling sweat equity shares, and these sweat equity shares are listed shares. How do I know? Because I'm selling them through stock exchange. I'm also paying STT. Then after capital asset, what is the next thing you check? The period of holding. When did I acquire these shares? When were they allotted to me? In May 2022. And when did I sell away the shares? On 31st March 2023. This period is definitely less than 12, 24 or 36. What is the relevant period of holding? Listed equity shares, guys. Relevant period of holding will be 12 months, and this is definitely less than 12 months. Therefore, this is going to be a short-term capital asset. Short-term capital asset, which section will apply over here? Will it be 111A or will it be normal rate STCG? It is listed equity shares. STT paid at the time of transfer. It's going to be section 111A STCG. Now we'll start off with the computation. How do we do the computation? First of all, what is the full value consideration for how much are we selling away the shares? We're selling the shares at 2,100 per share. So we have 2,100 per share into 1,500 shares. What is our full value consideration? It's going to be 31,50,000. From this, we subtract expenses on transfer. We don't have any expenses on transfer, we just read. So 31,50,000. This is going to be our net consideration. Then I come to the cost of acquisition step. Will I index the cost of acquisition? No, I will definitely not, because it is short term. So I'll straight away subtract the cost of acquisition. Now comes the star adjustment. What is the cost of acquisition for sweat equity shares? Whatever was your exercise price, that will not be your that will not be your cost of acquisition. Instead, FMV on the date of exercise of option, this will be your cost of acquisition. See, you actually spent 1,300 per share, but this will not be considered as cost of acquisition when you compute capital gains. Cost of acquisition will be nothing but FMV on the date of exercise of option. So when you exercised the option on that day, the FMV was 1,500. This is going to be your cost of acquisition. So cost of acquisition will be 1,500 per share into 1,500 shares, which is going to be 1,500 into 1,500, 22,50,000, which will result in net STCG under section 111A of totally 9 lakhs. Is this crystal clear for everybody? Yes, guys, how did I calculate this? The only thing over here which you might be getting a little stuck at would be this point. The cost of acquisition will be whatever is the FMV on the date of exercise of option. Right? So 9 lakhs is our STCG, even this is done. Then what else? The following transactions were made by Mr. Kamal during the previous year 22-23. We have some more transactions. He earned rental income of 35,000 per month from a 3 BHK residential flat at Delhi. He purchased the flat for 45 lakhs in June 2022 using the housing loan availed from the employer. Remember, he had borrowed a loan from his employer, the concessional housing loan. Using that loan, he has purchased a house in June 2022. It was let out from July 2022. Municipal taxes of 12,000 were paid by Mr. Kamal. Guys, he's having rental income. So which head of income will I talk about now? IFHP. So come to your main answer. Write down income from house property. Give reference to working note number 3. After your second working note, open the third working note with the heading IFHP. This is a let out property. Let out property, how do you start? You start with gross annual value. But have they given us municipal value, fair rent, standard rent? Have they given us those 3 numbers? Here we just read, we did not have those numbers. A quick glance at the rest of the question. They haven't given us all the 3 numbers. So when they don't give us all the 3 numbers, neither of the 3 numbers they have given us, you can use a shortcut. The shortcut will be actual rent minus unrealized rent minus vacancy loss. Now, what will the actual rent be? That's going to be a little tricky over here. The actual rent. He purchased the flat in June. He used the housing loan. It was let out from July. So can I say that for the month of June it was vacant? I have given the property on rent from July. Okay, I own the property from June, but I have given it on rent in July. So I can say in the month of June it is vacant. Okay. Actual rent is always calculated for the entire period for which you own the property. You own the property from June to March. So you're going to calculate actual rent for 10 months. 35,000 per month into 10 months. This is going to be 3,50,000. There is no unrealized rent, but I do have vacancy loss for the month of June. In the month of June, it was not given on rent. It was given on rent only in July. Only from July, it was let out. So I have 1 month of vacancy loss, and that is going to be 35,000. So now if I see the net number, what is my GAV? 3,15,000 will be my GAV. Understood, guys? My actual rent I'll calculate for the entire period for which I own the property, which is 10 months. And vacancy loss, month of June it is vacant. 3,15,000 is my GAV. From this, what do we subtract? Municipal taxes paid. How much municipal taxes have we paid? Municipal taxes of 12,000 were paid by Mr. Kamal. My assessee has paid 12,000 municipal tax. So the balance 3,03,000 becomes our net annual value. From this, we subtract deductions under section 24. Number 1, we will have standard deduction, which is going to be 3,03,000 into 30%, which will work out to 90,900. Then we also subtract interest on borrowed capital. As soon as I tell you interest on borrowed capital, what is that one thing that comes to your mind? What is the rule that we made for ourselves? I will think about pre-construction interest. Now, do we have pre-construction interest over here? See, listen, we borrowed the housing loan from the employer on 1st June. And we purchased the house also in June. So even before purchase, is any loan existing? No. When do we have pre-construction interest? We have pre-construction interest when even before construction is over, even before purchase is over, we had a loan. Then we'll have pre-construction interest. But here we acquired the house in June and we even took the loan in June. So before acquiring, we don't have any loan. Hence, there is no pre-construction interest. I will have only current year interest. Okay, but how will I calculate? What is this interest? Nothing but whatever interest I've paid to the employer. From the employer, I took a housing loan of 15 lakhs. This 15 lakhs, I'm going to pay 2.5% interest. But I took this loan only in the month of June, so only for 10 months. So what is the current year interest? This is going to be 31,250. Do we get this number? It is let out property, so I don't think about any limits and all. I'll straight away give this number as deduction. The question says he purchased the flat using housing loan availed from the employer. So how much ever I'm paying the employer, that's going to be my current year interest. Is it important that I have to borrow the loan only from my, only from, let us say, a bank or a financial institution and all? Not necessary. In IFHP, you can borrow from anywhere. You can borrow even from employer allowed. So what is my IFHP number now? 3,03,000 minus 90,900 minus 31,250. You will get 1,80,850. This is going to be your IFHP. Crystal clear? Yes. Now, after this, what else? He invested 30 lakhs in RBI floating rate saving bonds on 1st September 2022 and he earned an interest of 7% per annum. Interest is credited half yearly on 1st January and 1st July every year. Assume receipt basis for taxation. Guys, bonds, interest. Which head of income will this go to? IFOS. So I'll come to my main answer. I'll open another head. Income from other sources. This is IFHP. This is IFOS. I've written these short forms so that I can use these short forms in the rest of the question. So working note number 4, I'll open another working note with the heading IFOS. So we have number 1, interest from RBI bonds. Now listen, when did we buy the bonds? On 1st September 2022. 7% interest. Credited half yearly on 1st Jan and 1st July. Receipt-based taxation, which means whenever we received, that is when I'm going to tax. So during the current year, I have received only on 1st January, guys. Because see, I made the investment only in September. So after September, I would have received the interest in the current year only in January. So in January, how many months interest I would have earned? 30 lakh rupees I invested. Okay. Carrying how much interest rate? 7% interest rate. For how many months I would have received in January? September, October, November, December, only for 4 months. They are saying half yearly interest, but I made the investment only in September. So September to January, only 4 months interest I'm going to be getting, and that's going to be 70,000. 70,000 is our interest from bonds. Now it is interest from RBI bonds. Is it going to be exempt? See, interest from bonds will be exempt only if they say it is notified government securities. Interest from notified government securities will be exempt. But here they don't say notified government securities. No, they just say RBI bonds. So RBI bonds interest will be taxable. Then we paid LIC premium of 15,000 for self, 20,000 for wife, and 30,000 for dependent father. He paid LIC premium. This will go to which section? This will go to section 80C. 80C will go to which section? 80CCE, and 80CCE will go to which chapter? It will go to chapter 6A. So we'll open another working note for chapter 6A. Okay, under chapter 6A, first of all, we have section 80CCE. Under 80CCE, there are 3 parts: 80C, 80CCC, and 80CCD subsection 1. Right now, my assessee is paying LIC premium. LIC premium will go to section 80C. We can pay 80C, we can pay LIC premium for whom? Self, spouse, and children. So I will consider self 15,000. I will consider even spouse 20,000. But will I consider father, guys? No, I am supposed to consider only self, spouse, and children. Father, I will not consider. Then he's paying medical insurance premium on the health of dependent brother and major dependent son. 5,000 paid by check, 10,000 paid in cash. Medical premium will go to which section first of all? 80D. So I will leave some gap. I'll start another section, section 80D. Now 80D, if you see, there are 2 buckets, family bucket and parents bucket. In the family bucket, I have self, spouse, and dependent children. So first of all, will dependent brother be covered? No, only self, spouse, dependent children. Brother will not be covered. Only son will be covered. And son is also dependent. Good. But in 80D, I'm supposed to make the payment only in non-cash mode, irrespective of the amount. But for the son, I have paid in cash. Hence, I will not consider. So, under 80D, write down, dependent brother is not covered under section 80D. Then write down after that, while dependent son is covered under section 80D, deduction will be allowed. Deduction will not be allowed if payment is made in cash. Here for son, we have paid in cash. So deduction will not be allowed if payment is made in cash. So total 80D deduction will be 0. I will get no deduction at all. Then after that, anything else? In December 2022, he earned dividend income 5 lakh on shares of a bank held by him. Which section will this go to? Which head will this go to? IFOS. So under IFOS, we have dividend income. How much dividend income is he earning? 5 lakhs. That's it with the adjustments, guys. Come on, let's go ahead and close our working notes one by one. Our first working note was salary. Add up. What is your gross salary? How much do you get? 42 lakhs plus 40,000 plus 3 lakh plus 8 lakh 40,000. plus 68,750 plus 3 lakhs, you should be getting 57 lakhs 48,750 gross salary. But from this, I'll enjoy deductions under section 16. I'll have 3 deductions. Number 1, we'll have standard deduction. Standard deduction is always 50,000. No entertainment allowance here, no professional tax here. So what will be my net taxable salary? 56 lakhs 98,750. Go back to your main answer. Salaries 56 lakh 98,750. Okay. Then coming to the second working note, we've already closed it. We have STCG of 9 lakhs. Come back to your main answer. Capital gains in bracket side on STCG under section 111A. We have 9 lakhs. Then after that, what's our next working note? IFHP. Even this we've already closed. 1,80,850. Come back to our main answer. 1,80,850 IFHP. And finally, income from other sources we have 5,70,000. 5,70,000 here. So now if you add up, what is a gross total income of our assessee? Do you get this number? 73 lakhs 49,600. Okay, now we have chapter 6A. I can't straight away subtract chapter 6A. I have to split this into 2 parts. What is my normal rate income and what is my special rate income? What are my special rate incomes here, guys? It's only capital gains. Income from other sources, do I have any special rate income here? No, I don't have any betting, gambling income and all. So my only special rate income is capital gains. So special rate income, 9 lakhs. And what's the balance? The balance 64 lakh 49,600 will be my normal rate income. Now after this, less chapter 6A, give reference to working note 5. Come to working note 5. What's the total? ATC is 35,000. We don't have under ATCCC, we don't have under ATCCD1. So what is the total deduction under ATCCE? 35,000, which is also within the limit of what? What is the total limit for ATC plus ATCCC plus ATCCD1? 1,50,000. ATD was anyway 0. So total chapter 6A I will allow 35,000 only against normal rate income. But so my net number here will be 64 lakh 14,600. My special rate income is 9 lakhs. So what is my total income? Our total income will be 73 lakh 14,600. No need to round off because it is already in multiples of 10. All right, but see, I can't end my question here because they are also asking us to find tax liability. Okay, so after this, give the next heading, computation of tax liability. In computation of tax liability, what is the first thing that you generally check? You always start with identifying what the basic exemption limit is. Now, what is the basic exemption limit in this question? Question doesn't say my assessee is a senior citizen. He's not a senior citizen. So the basic exemption limit will be 2,50,000. Okay. Then what is my total income? Our total income is 73 lakh 14,600, which includes section 111A STCG of 9 lakhs. And then I have other income of 64 lakh 14,600. So I will utilize the full basic exemption limit against my other income first. So what will my tax liability be? My basic tax liability, guys. How will you calculate? Up to 10 lakhs. You anyways have to pay 1,12,500 plus 30% of your income in excess of 10 lakhs will be 54,14,600. So how much will this be? 54,14,600 into 30%. 30% of your income in excess of 10 lakhs plus 1,12,500. Do you get this number? 17,36,880 here. Then on section 111A, what will your tax rate be here? You don't have any basic exemption limit left. So it's going to be fully taxable at what rate? At 15%. So 9 lakh into 15%, 1,35,000 will be the tax here. So what is my total basic tax now? 17,36,880 plus 1,35,000. That's going to be how much? That's going to be 18,71,880. Until here, clear? 18,71,880. Normal calculation, guys. I hope you understood that 1,12,500 number and all. You know that, right? So 18,71,880 we have here. Then I think about rebate under section 87A. Will I have rebate? Of course not. My total income is much more than 5 lakhs. So I will straight away go to surcharge. Will we have surcharge? Yes, we will have surcharge. Our total income is 73,14,600. So total income is more than 50 lakhs up to 1 crore. So what's the surcharge rate? 10%, 10% of tax. So 10% of 18,71,880. Even on 15% STCG, even on this, can I give 10% surcharge rate? Yes. On 111A, maximum surcharge rate is how much? 15%. Here I am charging only 10%. This is allowed. So this is going to be 1,87,188. Then I will think about marginal relief. Even if you calculate, you will not have marginal relief here because your income is much more than 50 lakhs. Had your income been close to 50 lakhs, if it is close to the limit, then you calculate marginal relief. There's around 23 lakhs difference between 50 lakh and your total income. So no need to calculate marginal relief. Even if you calculate, it's going to be 0. So straight away after this, we'll add says, as of now, it is 37,43,760. We'll straight away add says at 4%, which is going to be 1,49,750. So the total tax will be I think I've made a mistake here. 18,71,880 plus 10%. This is wrong. This was 20 lakhs. 59,068. Now into this 4% will be 82,363. So total tax will now be 21,41,431, which we have to remember to round off to 21,41,430. Done, guys. Got it? Yes. So this was our final number on our tax liability. We first did the total income calculation and then we did the tax liability calculation. Right? So with this, even this question comes to an end. We're done with the total income question. Total income question, I think our biggest learnings here. Number one, this was an interesting adjustment about the concessional interest loan. Then even leave travel allowance, hotel bookings, I will not get the exemption. Then sweat equity shares was from both capital gains perspective also, salaries perspective also. Then this was interesting, calculating interest on the receipt basis. And the other adjustments were, I think, more or less simple. All right, so we'll close this question. Come on, guys, let us go to the last question now. Question number 15. This is from your assessment procedures chapter, that when do you have to quote your PAN number? Mr. Akash has undertaken certain transactions during 22-23 which are listed below. You are required to identify the transactions in respect to which quoting of PAN is mandatory. When do I have to quote my PAN? When is it mandatory? If you're going to open a current account, see, any bank account you open with the bank, any demat account you open, it is mandatory in all these cases, you have to quote your PAN number. Then you're selling shares of a company for 1,50,000. If you sell securities, if you sell shares for more than 1 lakh, then you have to quote your PAN number. Here it is more than 1 lakh, it is 1,50,000, so you have to mention your PAN number. Then purchase of two-wheeler motor vehicle of 1 lakh. See, for two-wheeler, PAN is not required. But had it been a car, had it been a four-wheeler, then it would have been mandatory. But because this is two-wheeler, that is why PAN is not mandatory here. For four-wheelers, PAN is mandatory. Then purchase of professional laptop of 3 lakhs. All these purchases more than 2 lakhs, PAN is mandatory. As it is more than 2 lakhs, you have to disclose your PAN. You have to quote your PAN. Okay, so current account, bank account, demat account, mandatory. Shares more than 1 lakh, mandatory. Debentures more than 50,000, mandatory. Mutual fund units also more than 50,000, it will be mandatory. Two-wheeler motor vehicle, 1 lakh. Two-wheelers not required. Only for four-wheelers it is required. And professional laptop, anything more than 2 lakhs required. All right, guys. So with this, we come to an end to our discussion on the RTP. All right. We've already discussed the MCQs in the last video. And in this video, we've taken up all the descriptive questions with proper presentation. All right. So we'll close over here. I'm sure the session would have benefited you all. We've seen some very good adjustments. All right. We'll close this here. Law RTP, I'll be putting up in some time. All right, so I'll close this over here, guys. I'll see you for the law RTP discussion. Thank you, guys. Bye-bye.